So back in January of 2026, something happened to the Bitcoin network that, well, it sent shockwaves through the entire industry. And what's fascinating is, depending on who you talk to, it was either the first sign that Bitcoin's security is totally broken, or it was a painful but completely normal reset that could signal a huge opportunity. All right, let's dig in and figure out what the data is actually telling us. It all went down over just one weekend. Get this. In 48 hours, the hash rate, the total computing power that keeps the Bitcoin network safe, it just plummeted by a staggering 40%. To put that in perspective, that's like 1.3 million mining machines just vanished, unplugged, all at once. We've literally never seen anything like it. And of course, it left everyone asking one huge question. Is this it? Is the fundamental economic engine that secures the entire Bitcoin network, is it finally breaking down? Is the whole thing cracking under pressure? To even begin to answer that, we've got to understand the forces that push the network to this breaking point.
So what we're looking at here isn't just one single problem. It was more like a perfect storm, Three huge, crushing forces that all hit Bitcoin miners at the exact same time. So let's break them down one by one, and we'll start with the most obvious culprit, the price of Bitcoin itself. Okay, so remember that insane high of $126,000 back in October 2025? Well, after that, Bitcoin's price just went into an absolute freefall. We're talking a collapse of over 52% in just 4 months, bottoming out around 60K. And for miners, their entire business model is built on a high Bitcoin price. So for them, this was just a devastating blow to their bottom line. And to really get a feel for how bad it got for miners, you have to look at this metric called hash price. It's basically the daily paycheck a miner earns for their computing power. And no surprise, as Bitcoin's price crashed, so did the hash price. It dropped from $55 all the way down to $35. This just squeezed their profit margins to almost nothing. And here's the real-world impact of that. It's just staggering. With profitability totally crushed, if a miner bought a brand new, top-of-the-line machine, they'd have to wait almost 3 years, 1,000 days, just to make their money back. In the tech world, that is basically an eternity. So of course, all new investment in mining gear just stopped, dead in its tracks. But that economic pressure, that was only force number one. The second major force was this industrial revolution happening right next door, the AI boom. And this quote from the CEO of Bitfarms, this is a huge publicly traded mining company, this sent absolute shockwaves through the community. They weren't just talking about cutting back. No, they were getting out of Bitcoin mining entirely to go chase the massive demand and the massive profits in AI. And yeah, they were not alone, not by a long shot. This was a full-on mass exodus of the biggest and wealthiest players in the game. You gotta remember, miners had the exact thing the AI industry is desperate for: huge data centers with access to just insane amounts of power. So you see Riot, Mara, Bitfarms, they all started selling off their Bitcoin holdings to pay for this pivot to AI. And what does that do? It just throws even more fuel on the fire, adding more selling pressure to an already falling market. So this double whammy of economic and industrial pressure left the network really vulnerable, which brings us to the knockout punch. Okay, so just picture this. Miners' profit margins are totally crushed. The biggest players in the industry are packing up and leaving. The network is already super fragile. And then, nature delivered the final blow. In late January 2026, a massive blizzard, Winter Storm Fern, just barreled across the United States. Now, this is where you can really see the storm's impact. And the reason it hit so hard is because a huge chunk of the network's hash rate is concentrated right here in the US, especially in Texas. The storm caused massive power outages at all these mining farms. Foundry, which is the biggest US-based mining pool, lost 60% of its power. And that was enough to drag the entire global network down by that 40% we talked about at the beginning. It was just a brutal, real-world lesson in the dangers of geographic concentration. So let's recap. You've got a price crash, a mass exodus to AI, and a freak natural disaster. It seems like an open and shut case, right? The network is collapsing. But, and this is where it gets really interesting, there's a twist. The on-chain analysts, these are the folks who live and breathe blockchain data, they look at this exact same set of facts and see something completely different. They don't call it a collapse, they call it a capitulation. So this is the core of the debate right here. You have two totally opposite ways to look at the exact same crisis. The mainstream story is, the network is dying, the security model is fragile and it's failing. But the on-chain story is completely different. This isn't failure, this is a feature. It's a brutal but totally necessary cleansing process that's purging the weakest miners to make the whole network healthier in the long run.
And this whole process has a name. It's called miner capitulation. It's basically a period of intense pain where the least efficient miners just can't make it anymore. They're forced to shut down their machines, and they often have to sell off their Bitcoin reserves just to cover their electric bills and pay off their debts. Yeah, it's super stressful, and it absolutely creates a ton of selling pressure on the market. But according to this theory, it's a feature, not a bug. And the reason they say that is because Bitcoin has this brilliant self-healing mechanism built right into its code. See, when a bunch of miners shut down and leave, the protocol automatically adjusts. It actually gets easier to mine new blocks. This difficulty adjustment means that for the miners who survived, mining suddenly becomes more profitable again. This helps ease the pain, and eventually it encourages new, super efficient miners to jump in. It's this beautiful, built-in cycle of stress, recovery, and then growth. And look, this isn't just some abstract theory. There's historical data to back it up. There's an indicator called the hash ribbon, and it's specifically designed to find these capitulation events. Now check this out. It flashed back in 2018, nailing the market bottom at $3,200. It flashed again in 2022, right in the middle of the FTX chaos, marking the $15,000 bottom. And guess what? The hash ribbon signal has been flashing nonstop since November 2025, right through this entire crisis. So if you just look at history, this has been one of the most reliable, most powerful buy signals in the history of Bitcoin. But, and this is a huge but, we have to step back and ask a really important question. Can history really repeat itself when the market has changed so fundamentally? Right, let's be super clear here. We've all heard it before. Correlation is not causation. Just because this pattern worked in the past doesn't mean it's a law of nature. And the big reason for that is because today's market has a massive new variable in play, something that just wasn't around on this scale in any of the previous cycles. And this is the game changer. We're talking about institutional money. You've got the spot Bitcoin ETFs, you have giant corporations, even some state governments holding Bitcoin in their treasuries. All told, they now control almost 16% of the entire supply. Think about that. That's nearly 1 out of every 6 Bitcoin. Their decisions, their buying and selling, introduces a whole new force into the market that could completely overpower those old historical patterns we saw with the miners. Which leaves us with the ultimate question, doesn't it? What we're watching right now is a clash of titans. On one side, you have this 15-year-old battle-tested network mechanism, this cycle of death and rebirth that's always worked before. And on the other, you have a brand new market completely driven by these massive institutions. So while all the classic on-chain signals are screaming that this is a historic buying opportunity, this new institutional layer adds a whole new level of what if. And the way this plays out, it's not just going to decide the next big price move. It could redefine the security and the very nature of Bitcoin for years to come.